It was a few years before the COVID-19 era that South Africa started to lose favour with foreign investors. This due to concerns around the country's economic policy direction and adverse ratings actions that took the country's debt status into junk.
Back in 2018, foreigners held 42% of South African bonds in issuance, and that reduced in sort of just before COVID to 37%. So they were lightening up. Of course, all the time we're issuing more bonds and their relative ownership is reducing. And then it takes us to where we are at the moment, and they're only around 24%. So as a percentage of holdings, they have reduced. And what's happened, of course, South Africa lost its investment grade rating. And so we can't fit into investment grade mandates anymore.
But now the investment tide appears to be moving positively into South African bonds, with National Treasury data indicating the same.
Those show reliably how foreign holdings have increased for the year, and year to date it's sitting at purchases of around 86 billion to the end of August. Then I quite still like to look at the Bloomberg numbers, but not the ones that show all trades, just the sort of the actual seeming market trades done by foreigners. And year to date, those are around 116 billion up until yesterday. So you've got that's about another 30 billion on top, so 30 billion for September.
A factor that could work in South Africa's favour is the JP Morgan Emerging Market Bond Index, hinting that it may reduce its exposure to India and China.
And the beneficiaries we would be one of, because we're in that index, and our weighting would then go up proportionately. So that's one thing that we are seeing. Why are we sticking out? Well, there's a few things going on globally, of course. We've got this new and strange sort of world of geopolitical risk, which is tariff behavior and reciprocal tariff behavior. And we're not completely sure where this ends. But what we've seen, of course, one of the consequences, and maybe even sort of subtle strategies, is a weaker dollar. And just by virtue of that, we've seen more rand stability.
Terp says bond investors are also excited at the Reserve Bank explicitly indicating that it will now target the lower end of the inflation target range, namely 3%, because it will be positive for their investment returns in the long run.
As a bond investor, what eats up your yield is inflation. And to maintain lower inflation, or to get inflation down, you have higher short-term rates temporarily. And what that does is flattens your yield curve, because it makes the holding and then the real return of your nominal bond that much greater over time.
While the fundamentals are currently looking good from a bond investor's perspective, they will continue to keep a keen eye on the country's debt dynamics. In its final budget presentation in May this year, National Treasury indicated that debt to GDP would average around 77% this year. Investors will be keenly watching to see how government finances, particularly debt, is being managed at the midterm budget policy statement in November. Nampumelo Siziba, SABC News, Johannesburg.